Beginnings, Introduction. Welcome, my friend, to the very first step on what J.L. Collins calls the simple path to wealth. Before we dive into charts, strategies, and numbers, the author wants us to pause and reflect on something deeper, our relationship with money. In this introduction, Collins explains why he wrote the book in the first place. The story doesn't begin in a finance classroom or on Wall Street, it begins at home, with his daughter. Like many parents, he wanted to prepare her for life. She was growing up in a world where money touches everything, where financial independence can mean freedom, and financial ignorance can mean a lifetime of stress. He wanted to pass along the lessons he had learned over decades of trial, error, and success. So he began writing letters to her, letters that eventually became the foundation of this book. From the very beginning, Collins makes it clear, wealth is not about becoming rich for the sake of riches. Instead, wealth is about freedom. Freedom to choose how you spend your days. Freedom to walk away from a job you dislike. Freedom to live life on your own terms. He calls this concept FU money, money that gives you the power to stand tall, make choices with integrity, and not be controlled by fear of losing a paycheck. He contrasts this with the reality most people face. Many chase after more money without ever asking, what is this really for? They become trapped in cycles of debt, consumerism, and constant anxiety about keeping up. Collins invites us to step off that treadmill and to see money not as the end goal, but as a tool to buy back our time, reduce our stress, and create lives of meaning. What makes this introduction especially powerful is Collins' reassurance: you don't need to be a financial genius to succeed. In fact, the financial industry often makes investing deliberately complicated so it can sell products, fees, and advice you don't really need. But the truth is simple. The stock market, when approached with patience and discipline, can be your greatest ally. Over the long run, it always rises. And by learning a few timeless principles, anyone, yes, even you, can build wealth steadily and securely. The introduction closes with a promise. This book isn't about complex strategies or insider tricks. It's about stripping away the noise and focusing on what works. Think of it as a map, a guide to the treasure chest that already exists within reach. Collins assures us that while the journey to financial independence requires discipline, it doesn't require luck, timing the market, or gambling on risky bets. Instead, it requires clarity, simplicity, and consistency. So, as we step into the chapters ahead, the introduction leaves us with a clear vision. This path is not about money itself, but about the life money can give us, the freedom, the independence, and ultimately, the peace of mind we all crave. A parable, the monk and the minister. Imagine, if you will, two old friends walking down a dusty road in ancient China. The sun is low, the air is quiet, and the future of their lives stretches before them in two very different directions. One of them is a monk, serene, devoted to a life of simplicity, prayer, and spiritual pursuit. The other is a minister, ambitious, climbing the ranks of government, entangled in the power, politics, and responsibilities of his position. As they walk together, the minister turns to the monk and asks with a mixture of wonder and perhaps a touch of envy, if you were to devote your life to serving the emperor as I do, imagine the influence you could wield, the good you could accomplish for so many people. The monk pauses, smiles gently, and replies, and you, my old friend, if you would step away from the palace and live as I live, imagine the peace you could feel, the freedom you could taste. This short exchange, Collins explains, is more than just a parable, it is a mirror for our own choices in life. Each path has value, but each comes with a price. The minister represents the pursuit of status, wealth, and power, the endless chase of worldly success. The monk represents contentment, simplicity, and freedom, the decision to step away from the constant struggle and find joy in less. Why begin a book about money with this story? Because, Collins reminds us, money is not the goal, it is only the tool. Wealth can buy comfort, security, and opportunity, but beyond a certain point, more money does not necessarily bring more happiness. The key is to be intentional about which path you choose. Do you want the minister's life, busy, complicated, and consumed with endless striving, or the monk's life, free, peaceful, and rooted in independence? And here is the deeper wisdom: you don't have to give up everything and live in a monastery to taste that freedom. By mastering your money, by saving, investing simply, and avoiding debt, you can create a life that has the best of both worlds, the independence of the monk and the resources of the minister. That is the essence of the simple path to wealth, a path that honors freedom over consumption, peace over stress, and simplicity over endless complexity. Collins leaves us with a challenge: think carefully about what you truly value. If money is only a tool, what will you use it to build? Will it trap you in a life you don't want, or will it free you to live a life on your own terms? My story, it has never been about retirement. J.L. Collins pauses here to share something deeply personal, his own journey with money. And right away, he tells us something surprising: for him, it has never really been about retirement. From the outside, it might seem like Collins built his path to wealth so he could leave work early and live a life of leisure. But he makes it clear, that was never the point. He loved working. He enjoyed creating, learning, and being productive. Retirement, in the traditional sense, was not the dream. What he wanted instead was freedom. As he reflects on his early years, Collins admits he made many of the same mistakes we all make. He got caught up in the allure of stuff, the cars, the lifestyle, the constant sense that money was something to be spent rather than something to be grown. And like so many of us, he had moments when money, or the lack of it, controlled his choices. Jobs had to be taken. Opportunities had to be passed up. Stress was constant. Slowly, over time, he realized something profound: the more he saved and invested, the more control he gained over his life. Wealth wasn't about buying luxuries. It was about buying back his independence. Each dollar saved was like a tiny soldier fighting for his freedom. Each investment was a seed planted for a future where he could choose what to do with his time. And then comes one of the most important ideas in this book: the concept of FU money. Collins doesn't sugarcoat it. He explains that there will always be moments in life when someone tries to hold power over you, a boss, a corporation, a system. But when you have enough money saved, you have the ability to walk away. You don't need to bend, you don't need to compromise your integrity, and you don't need to live in fear. That, he says, is the true goal: not retirement, but power over your own life. Throughout his story, Collins weaves in a sense of humility. He admits he's not a Wall Street genius or a financial wizard. Instead, he simply learned, often the hard way, that simplicity, consistency, and patience win in the end. He discovered that the path to wealth is not about chasing every new trend or timing the market. It's about understanding that the stock market, despite its ups and downs, always rises over time. By owning a piece of that growth and holding it for the long haul, financial freedom is almost inevitable. In this chapter, we also feel Collins' love for his daughter, because much of this book began as letters to her. He wanted her to avoid his mistakes, to understand that money is not the enemy, and to see that real wealth is measured not by the size of a bank account, but by the ability to live life on your own terms. So when Collins says, it has never been about retirement, what he really means is this: retirement is just one version of freedom. But the bigger picture is independence, confidence, and peace of mind. Money, wisely handled, gives you that. And that's the life he has lived, and the life he wants his readers, and his daughter, to live too. Important notes. Before the real journey begins, J.L. Collins pauses to share a few important notes with the reader, guidelines to keep in mind as we walk the path together. These notes are not technical lessons but rather principles, the kind of reminders that can save us from unnecessary stress later on. The first note is about simplicity. Collins emphasizes again and again that the financial world thrives on complexity. Advisors, banks, and fund managers often want you to feel overwhelmed, because when you feel lost, you rely on them, and pay them. But the truth, he insists, is that successful investing is actually very simple. Wealth doesn't require complicated strategies or a team of experts. It requires discipline, patience, and sticking to the basics. This book is built to strip away the noise and show you that simple really is better. The second note is about fear and greed. These are the two emotional forces that drive most people to make poor money decisions. When markets rise, greed tempts us to chase after hot stocks or get-rich-quick schemes. When markets fall, fear pushes us to sell in panic. Collins urges us to keep calm, stay the course, and remember that markets always recover. Understanding this emotional cycle, and protecting ourselves from it, will be key to our success. The third note is about audience. Collins wrote this book originally for his daughter, and by extension, for people just like her, those who may not have a background in finance, but who want clarity, guidance, and reassurance. That means the tone is straightforward, the advice is actionable, and the goal is not to impress but to empower. The book is for ordinary people who want to build extraordinary freedom. Another note touches on personal responsibility. Collins makes it clear, this isn't about handing over control of your financial life to someone else. This is about taking ownership. Once you understand the principles, you no longer need to depend on an advisor, a corporation, or even luck. You'll have the tools to steer your own ship. Finally, Collins offers a gentle reminder, this book is a map, not a guarantee. The principles are time-tested and powerful, but the journey is still yours to walk. There will be storms in the market, there will be doubts, and there will be moments when the world screams at you to do the opposite of what is wise. These notes are Collins' way of preparing you, to steady your mind, to remind you of the bigger picture, and to anchor you before we move forward. And so, with these notes tucked safely in your pocket, the stage is set. Ahead lies the path itself, the tools, the strategies, and the mindset that will allow you to build wealth, keep wealth, and most importantly, use wealth as the key to freedom. Orientation. 1. Debt, the unacceptable burden. Debt, Collins says, is like a heavy chain you willingly strap around your neck. At first, it might feel manageable, just a small monthly payment, just a little obligation. But over time, those links grow heavier, dragging you down, limiting your choices, and suffocating your freedom. He wants us to see debt for what it really is, the opposite of wealth. While investing allows money to work for you, debt does the reverse, you work for money, and often, you work for someone else's wealth. The lender grows richer while you remain trapped. Collins is especially critical of high-interest debt like credit cards. He calls them financial quicksand. Even a small balance, if left unpaid, grows rapidly until it feels impossible to escape. The message is clear, if you are serious about financial independence, your first mission must be to destroy debt. Every dollar you owe is a dollar that keeps you from freedom. He also touches on mortgages and student loans, types of debt that can be more complicated. A mortgage, he explains, can be acceptable if it's modest and if the house you buy is truly within your means. Student loans, while sometimes necessary, should be minimized as much as possible. The guiding principle is this: debt is dangerous, and the less of it you carry, the faster you can run toward independence. 2. Why you need FU money. Here Collins introduces one of the most famous and liberating ideas in his book, FU money. What is it? It's the amount of money that gives you the power to walk away. Walk away from a toxic job, from a manipulative boss, from a deal that compromises your values. It doesn't mean you never work again, it means you never work out of fear. FU money doesn't have to be millions. In fact, in the beginning, it can be just a small cushion, enough savings to cover a few months of expenses. Even that small amount changes the way you move through the world. You become less desperate, more confident, more able to make choices that align with who you are. Collins shares how in his own life, having FU money gave him courage. Courage to negotiate, to say no when needed, to live life without constantly bending to the will of others. This chapter is less about numbers and more about mindset. The goal of building wealth isn't just to retire, it's to claim your power. 3. Can everyone really retire a millionaire? It might sound like a fantasy, but Collins argues it's entirely possible, if you start early, live below your means, and consistently invest. The math is surprisingly straightforward. The stock market, over long stretches of time, has always grown. With steady saving and the miracle of compounding, ordinary people can reach extraordinary results. He explains compounding in simple terms: money makes money, and that money makes more money. A dollar invested today doesn't just grow, it multiplies, quietly, relentlessly, in the background of your life. Over 30 or 40 years, even modest contributions can grow into staggering sums. Of course, this requires discipline. You must resist the temptations of overspending, avoid lifestyle inflation, and focus on the long game. But the promise is real. Yes, an ordinary worker, earning an ordinary salary, can retire not just comfortably but wealthy. The millionaire lifestyle is not reserved for the elite, it is accessible to anyone willing to follow the simple path. 4. How to think about money. Here Collins challenges us to reframe our entire relationship with money. Most people think of money as something to be spent. But if you want financial freedom, you must learn to think of money as a worker. Every dollar you earn has potential. You can either send it out to work for someone else, by spending it on cars, gadgets, or fleeting pleasures, or you can put it to work for yourself, by saving and investing it. If you choose the latter, each dollar becomes an employee in your own personal army. And over time, that army grows so large it supports you for life. Collins reminds us that money is not evil, nor is it magical. It is neutral. It simply takes the shape of your intentions. Used wisely, it can create freedom. Used poorly, it can enslave you. This chapter is a call to awareness, to stop sleepwalking through financial life and instead treat each decision with care. 5. Investing in a raging bull, or bear, market. Finally, Collins prepares us for the emotional roller coaster of investing. The stock market will rise, and when it does, excitement will tempt you to believe it will rise forever. Then it will fall, and when it does, fear will whisper that it will never recover. Both are illusions. Collins has lived through multiple booms and busts. Each time, the pattern is the same: fear and greed drive behavior, and people who panic lose money. But those who stay the course, those who remain calm, always come out ahead. He warns us not to think of ourselves as smarter than the market. Timing it, trying to guess the highs and lows, is a fool's game. The real wealth builders are not those who trade constantly, but those who invest steadily, ignore the noise, and let time do the heavy lifting. This final chapter in orientation is a preparation for what lies ahead. The journey will not always feel easy. There will be turbulence. But if you can master your emotions and trust the process, the reward is freedom, true, lasting freedom. Closing of orientation. With these 5 lessons, Collins completes the orientation phase of the book. It is like standing at the trailhead of a great journey. He has told us what to avoid: debt, what to strive for, money, what is possible, wealth for anyone, how to think, money as a tool, not a toy, and how to endure the storms, patience through bull and bear markets. We are now prepared to move forward into the heart of the path: how to harness the world's most powerful wealth-building tool. How to harness the world's most powerful wealth-building tool. This is the longest and most detailed section of the simple path to wealth. Here, Collins breaks down why the stock market is your greatest ally, how to use it wisely, and how to avoid the common traps that keep most people from building real wealth. I'll take you through each chapter in audiobook style, one by one. 1. There's a major market crash coming. And even famous economists can't save you. Collins begins with a simple truth: nobody knows when the market will crash. Not economists, not experts on TV, not best-selling authors, and certainly not the man at your office who claims he saw it coming. The market rises and falls. Sometimes it booms, sometimes it collapses. That cycle is normal. What isn't normal is the way people react, with panic, fear, and a desperate attempt to outsmart everyone else. Collins wants us to stop looking for predictions. Instead, we must accept reality: crashes are inevitable. And because they are inevitable, they must be planned for, not feared. He reminds us that every crash in history has eventually been followed by recovery, and usually by growth that takes the market to new heights. The lesson: don't try to time the storm. Build a boat that can ride it out. 2. The market always goes up. This sounds too simple to be true, but Collins backs it with history. From its beginnings in the late 1700s to today, the U.S. stock market has always risen in the long run. Wars, depressions, recessions, pandemics, political turmoil, none of it has stopped the upward march of progress. Why? Because the stock market is not just numbers on a screen, it is ownership in businesses. And businesses, over time, innovate, grow, and create wealth. Collins urges us to zoom out. If you look at a daily chart, the market looks chaotic, spikes and crashes. But pull back to 10, 20, or 50 years, and the line smooths into a steady upward climb. This is why long-term investing works. The market, in the end, always wins. 3. Why most people lose money in the market. If the market always goes up, then why do so many people fail? Collins' answer: because they can't control their emotions. Greed makes people buy high, chasing after hot stocks when prices are inflated. Fear makes them sell low, dumping investments when markets fall. The result? They do the exact opposite of what works. He also calls out Wall Street and the financial media for feeding this cycle. Headlines are designed to scare or excite. Brokers profit from constant trading. Advisors sell complexity. The system is built to make you do something, when in reality, the smartest move is usually to do nothing. The secret is this: stay calm, keep investing, and ignore the noise. 4. The big ugly event. Here Collins describes the painful reality of major crashes, the ones that wipe out fortunes and terrify even seasoned investors. He calls them the big ugly events. These crashes hurt. They are brutal to watch. But Collins reminds us, they are also opportunities. In every crash, stocks go on sale. The disciplined investor who keeps buying during downturns is the one who comes out wealthy when the market recovers. He admits, living through these events isn't easy. It takes emotional strength to see your portfolio drop by 30 to 50% and not panic. But history shows, those who endure, win. Those who run, lose. 5. Keeping it simple: considerations and tools. At this point, Collins introduces the core philosophy of the book: simplicity. Forget chasing dozens of funds or exotic investments. The key is to invest in low-cost index funds, funds that simply buy the entire market. They are cheap, reliable, and almost impossible to beat over the long haul. He explains why fees matter. Even a 1% annual fee, compounded over decades, can cost you hundreds of thousands of dollars. This is why simplicity isn't just easier, it's more profitable. 6. Index funds are really just for lazy people, right? Critics often say index fund investors are lazy, that they're not trying to beat the market. Collins laughs at this. In truth, most professional fund managers, with all their research and resources, still fail to outperform the market. So if you can't reliably beat the market, the smartest move is to own the market. That's what index funds do. And because they're cheap, tax efficient, and automatic, they consistently outperform the vast majority of actively managed funds. Lazy? No. Smart. 7. Bonds. Not all of your money should be in stocks, especially as you get older. Collins introduces bonds as the stabilizing force in your portfolio. Stocks provide growth, but they can be volatile. Bonds provide income and reduce risk. The balance between stocks and bonds, your asset allocation, depends on your age, risk tolerance, and financial goals. Younger investors can afford more stocks. Older investors may want the security of bonds. The right mix allows you to sleep at night while still growing wealth. 8. Portfolio ideas to build and keep your wealth. Here Collins puts it all together. He shares sample portfolios, simple combinations of stock and bond index funds, that can serve as lifelong investment strategies. The goal isn't to find the perfect portfolio. The goal is to find a portfolio you can stick with for decades without tinkering. Consistency beats cleverness. 9. Selecting your asset allocation. Collins digs deeper into the art of balance between risk and safety. Asset allocation is not about guessing the future, it's about knowing yourself. Can you stomach a 50% drop in your portfolio without panicking? If so, more stocks might suit you. If not, add bonds. The best portfolio isn't the one with the highest returns, it's the one you won't abandon in fear. 10. International funds. Should you invest internationally? Collins' view, you don't need to. The US market is large, diverse, and global in reach. Many American companies already earn huge portions of their revenue overseas. That said, he doesn't forbid it. If owning international funds gives you peace of mind, add a small percentage. But remember, simplicity is power. 11. TRFs, the simplest path to wealth of all. Target retirement funds, TRFs, are prepackaged portfolios that automatically adjust your asset allocation as you age. They're simple, easy, and require no management. Collins likes them, especially for beginners. But he also notes they can carry slightly higher fees than building your own index fund portfolio. For those who value convenience, TRFs are excellent. For those willing to do just a little more work, building your own can be even cheaper. 12. What if you can't buy VTSAX? Or even Vanguard? Collins' favorite fund is Vanguard's Total Stock Market Index Fund, VTSAX. But what if you don't have access to it? Don't worry. Other companies, Fidelity, Schwab, etc., offer similar total market funds. The name doesn't matter. The principle does: own the market, keep costs low. 13. What is it about Vanguard anyway? Collins explains his admiration for Vanguard. Founded by Jack Bogle, Vanguard is structured differently than most companies. It is owned by its investors. That means its focus is on lowering costs and serving shareholders, not extracting profits. For Collins, Vanguard embodies the philosophy of simplicity, integrity, and alignment of interests. That's why he champions it so often. 14. The 401k, 403b, TSP, IRA and Roth buckets. Now Collins shifts to tax-advantaged accounts, the vehicles that supercharge your investing. He breaks down each one. 401k/403b/TSP, employer-sponsored retirement plans. Traditional IRA, individual retirement account with tax-deferred growth. Roth IRA, contributions are after tax, but growth and withdrawals are tax-free. The strategy is simple: use these accounts to reduce taxes and grow faster. Always take advantage of employer matches, it's free money. 15. RMDs, the ugly surprise at the end of the tax-deferred rainbow. Collins warns about required minimum distributions, RMDs. These are mandatory withdrawals the government forces you to take from retirement accounts after age 72. They can create large tax bills if you've saved heavily. The lesson: plan ahead. Consider Roth contributions or conversions to minimize future tax burdens. 16. HSAs, more than just a way to pay your medical bills. Health savings accounts, HSAs, are unique. They combine three tax advantages: contributions are pre-tax, growth is tax-free, and withdrawals for medical expenses are tax-free too. Collins argues they can also be used as stealth retirement accounts. If you don't use the money for medical bills now, you can invest it, let it grow, and later use it like an IRA. A powerful tool often overlooked. 17. Case study: putting the simple path to wealth into action. To show how all of this comes together, Collins walks us through a real-life case study. An ordinary person, with an ordinary salary, applies the principles, avoids debt, saves consistently, invests in low-cost index funds, uses tax-advantaged accounts, and keeps calm through market swings. The result? Over time, this person achieves financial independence, living proof that this system works, not just in theory but in practice. 18. Why I don't like investment advisors. Finally, Collins returns to one of his strongest stances: be very cautious with investment advisors. Most are not truly fiduciaries, meaning they don't put your best interest first. Many are salespeople, making commissions on products you don't need. Their fees, even small ones, eat away at your wealth over decades. He acknowledges there are a few good ones, but insists, once you understand these simple principles, you won't need them. You'll be your own best advisor. Closing of section. And with that, Collins concludes the most important section of the book. We now understand the rules of the game, the tools we need, and the traps to avoid. The stock market is no longer a mystery. It is simply the engine that, with time and patience, will carry us to freedom. Ahead, Collins shifts gears to the next stage, magic beans, where he exposes the myths, cons, and illusions that distract so many investors from the simple path. Magic beans. Jack Bogle, and the bashing of index funds. Imagine a world where everyone believes that wealth must be complicated, that secret formulas and clever tricks are the only way to riches. In that world, a simple idea, an idea so clear and so effective that anyone could use it, might seem too good to be true. It might even be dismissed as magic beans. That, in essence, is the story of index funds. J.L. Collins opens this chapter by reflecting on how often people resist simplicity. When you tell them that the best way to build wealth is to simply buy and hold low-cost index funds, they look at you like you're offering them a fairy tale, a bag of beans in exchange for their hard-earned money. But just as Jack discovered that his magic beans held a power beyond imagination, investors who trust index funds often find that they unlock something extraordinary: steady, reliable growth over time. At the heart of this revolution is a man named John C. Jack Bogle, the founder of Vanguard and the father of the index fund. In the 1970s, Bogle dared to suggest that most people would be better off simply owning the entire market rather than trying to beat it. Instead of chasing hot stocks or relying on expensive managers, he proposed a radical idea: create a fund that mirrors the market itself, keeps costs rock bottom, and lets compounding do the work. The financial industry laughed at him. They said no one would ever buy such a product. They mocked it as Bogle's folly. After all, how could something so plain compete with flashy funds promising big returns? But Bogle's conviction never wavered. He believed, with near religious certainty, that this was the single best tool for ordinary investors. Over time, the results proved him right. Index funds consistently outperformed the majority of actively managed funds. Why? Because costs matter. While managers charge high fees and trade frequently, bleeding money with every decision, index funds quietly and efficiently capture the full return of the market. They don't try to be clever. They don't gamble. They just work. Yet despite the overwhelming evidence, index funds have always faced resistance. Why? Collins explains that much of the financial industry has a vested interest in keeping you from discovering them. If you put your money into an index fund, you don't need to pay an advisor. You don't need to buy into complicated products. You don't need to be sold anything. For Wall Street, that's bad for business. And so, index funds are often criticized, dismissed, or painted as too simplistic. Collins draws a parallel here: just like in fairy tales, the simplest tools are often the most powerful. Jack's beans grew into a beanstalk that reached the heavens. Likewise, index funds grow silently, year after year, carrying your wealth upward. They may not be exciting. They may not make headlines. But over decades, they build fortunes. To bring the lesson home, Collins reminds us of two essential truths. 1. Index funds are not magic. But they work like magic. Their power comes from mathematics, from compounding, and from efficiency. 2. Most investors sabotage themselves. By chasing fads, paying fees, and panicking in downturns, they miss out on the simple, proven strategy that works best. In the end, Collins honors Jack Bogle as one of the greatest champions of the ordinary investor. Bogle gave the world a gift, a tool that truly democratized wealth building. He planted the beans, and millions of people have since climbed the beanstalk to financial independence. The lesson is clear: don't be fooled by the noise, the critics, or the magic alternatives Wall Street tries to sell you. The humble index fund, plain and unassuming, is your real ticket to freedom. Magic beans: why I can't pick winning stocks and you can't either. Every investor at some point has dreamed of finding the next Apple, Amazon, or Tesla, the stock that explodes in value and turns ordinary people into millionaires. It's a tempting fantasy. J.L. Collins calls this the magic beans myth, the belief that somewhere out there is a handful of golden stocks that, if only we were smart enough, we could find and ride to riches. But here's the hard truth Collins lays bare: neither you, nor he, nor even the professionals can reliably pick those winners. Stock picking is like chasing magic beans: it promises glory but almost always leads to disappointment. The problem of hindsight illusion. Think about the companies that changed the world: Google, Microsoft, Netflix. Looking back, it feels obvious. Of course Google would dominate search. Of course Netflix would crush Blockbuster. But at the time, it wasn't obvious at all. For every Google, there were dozens of competitors that failed, names you don't even remember. For every Amazon, there were Pets.com, Webvan, and hundreds of others that went to zero. Hindsight makes the winners look inevitable, but in real time, it was a lottery. Collins reminds us, spotting winners after the fact is easy. Spotting them before? Nearly impossible. The professional track record: worse than you think. If ordinary investors can't pick stocks, what about the pros? After all, they have armies of analysts, insider contacts, and data models. Surely they can beat the market. The research says otherwise. Study after study shows that most professional fund managers fail to beat simple index funds over the long run. Worse, you usually can't know in advance which few will succeed. Collins cites one famous study: over a 20-year period, nearly 90% of actively managed funds underperformed the market. That means if you picked a star manager, odds are you lost money compared to if you had just bought the index. So if even the best-equipped professionals can't reliably find magic beans, what chance do you or I have? Survivorship bias, the hidden trap. One reason people believe in stock picking is survivorship bias. You hear about the winners. The people who got rich buying Tesla early, or the fund manager who crushed the market last year. What you don't hear are the thousands who lost everything on stocks that vanished. The market quietly buries its losers, but parades its winners. This creates the illusion that picking is possible, when in reality, the odds are stacked brutally against you. The human cost of chasing magic beans. Collins also warns of the psychological toll. When you chase stocks, you're always second-guessing yourself. Should I sell now or hold? What if I'm wrong? What if I miss the next big one? This creates stress, anxiety, and often disastrous mistakes. You sell too soon, you hold too long, you buy too late. Either way, you end up behind. And worse, chasing magic beans distracts you from the boring, reliable wealth-building method: buying broad index funds and letting compounding do the heavy lifting. The beauty of index funds: owning all the magic beans. Here's the genius of index funds: you don't have to pick winners. You own them all. When Apple becomes a trillion-dollar company, you're there. When Amazon grows from bookseller to global empire, you're there. When some new company you've never even heard of changes the world, you're there too. At the same time, when losers go to zero, you barely notice, because they vanish inside the index. Index funds are like a giant basket of beans. Some are magic, some are rotten. But you don't have to know which is which. Over time, the magic beans grow so big they carry the whole basket upward. The core lesson. Collins delivers it simply: I can't pick winning stocks, and you can't either. And that's okay, because you don't need to. The path to wealth isn't about being clever enough to find the next big thing. It's about being disciplined enough to stop trying. By accepting that you can't pick stocks, you free yourself from the illusion of magic beans and embrace the real magic: compounding, patience, and the market itself. The takeaway. Stock picking feels exciting, but it's gambling in disguise. Even professionals mostly fail. Survivorship bias hides the countless losers. Index funds let you own all the winners automatically. In other words, stop chasing beans. Plant your money in the fertile soil of index funds, leave it alone, and watch your wealth grow. Magic beans: why I don't like dollar cost averaging. Imagine this. You've just come into a large sum of money. Maybe it's a bonus. Maybe it's an inheritance. Maybe you've finally saved up a sizable amount and you're ready to invest. Now, here's the big question: do you put it all in the market at once? Or do you spread it out slowly, a little each month, using what's known as dollar cost averaging, or DCA? Most people, when faced with that choice, will lean toward DCA. It feels safer. It feels smarter. It feels like you're protecting yourself from a big crash that could happen the very next day. And that's exactly why so many financial advisors recommend it. Not because it's mathematically superior, but because it calms your nerves. The illusion of safety. Dollar cost averaging works like this: instead of putting $100,000 into the market right away, you might put $10,000 in each month for 10 months. That way, if the market drops after the first month, you don't take the full hit. You still have money waiting on the sidelines, ready to buy in at cheaper prices. It sounds clever. It sounds careful. But Collins reminds us of a hard truth: the stock market, over the long term, always goes up. Not every week. Not every year. But decade after decade, it rises. So by holding money back, by letting it sit idle in cash while you ease in, you're actually delaying the very growth you're hoping to capture. The math behind the choice. Here's what the data shows. Lump sum investing beats dollar cost averaging about 2/3 of the time. Why? Because 2/3 of the time, the market is higher a year from now than it was when you started. That means every month you wait to put more money in, you're buying at higher prices, not lower. Think of it this way: if the elevator is going up, why keep standing in the lobby, waiting to get on? The sooner you step in, the higher you'll ride. Why people still do it? If lump sum is so clearly the winner, then why does DCA remain so popular? The answer is fear. Fear of bad timing. Fear of watching a lump sum cut in half overnight. Fear of regret. And Collins doesn't dismiss that fear. He knows it's real. He knows it keeps many people awake at night. That's why he says, if the only way you can bring yourself to invest is by dollar cost averaging, then do it. Because even a cautious strategy is better than doing nothing at all. But, don't fool yourself. That's not about maximizing returns. That's about managing your own emotions. When DCA makes sense. There are two times when dollar cost averaging is perfectly logical. 1, when you're investing income as you earn it. Every paycheck, you contribute to your 401k or IRA. That's naturally dollar cost averaging. And that's great, it's automatic and steady. 2, when fear is paralyzing you. If spreading out your money is the only way you can get invested at all, then yes, do it. A slow entry is still far better than staying out of the market altogether. The bottom line. Collins' message is blunt, but freeing. If you already have a pile of money saved, put it to work immediately. Don't let fear keep your dollars sitting idle. The market has one direction over time, upward, and the sooner your money gets on board, the better. Dollar cost averaging may soothe the heart, but lump sum investing builds the wealth. And with that, the lesson is clear: the magic bean isn't in trickling your money in slowly. The real magic is time in the market, letting compounding do its relentless work. Magic beans: how to be a stock market guru and get on CNBC. Picture this for a moment. You're sitting in a glossy TV studio. Bright lights overhead. Cameras pointing at you. The anchor turns, smiling, and asks, "So, what's your market prediction? Where do you think stocks are headed next?" You lean in, with confidence, and say, "The market is about to soar." Or maybe, "A massive crash is coming." The audience watching at home doesn't know you. But in that moment, you sound like a wizard. A financial prophet. A stock market guru. That, Collins says, is the secret formula for becoming a market expert on television. The game of predictions. The truth is, financial television runs on one thing: bold, confident predictions. If you say the market will rise, and it does, you're invited back. If you say it will fall, and it falls, you're invited back. If you're completely wrong, don't worry. No one remembers. You can just make another prediction. This is the revolving door of financial media, endless talking heads, each one claiming to know what's coming next. And the more dramatic you sound, the more attention you get. Why people love gurus. Here's the psychology behind it. People crave certainty. We want someone to tell us, "Don't worry, it's all going to be fine." Or the opposite: "Watch out, danger is ahead, protect yourself now." That kind of certainty feels comforting, even when it's completely baseless. And that's why gurus exist. Not because they know, but because audiences demand someone who acts like they know. The problem with predictions. Collins lays it out plainly: nobody knows what the stock market will do tomorrow, next week, or next year. The short-term movements of the market are random. Even the greatest investors in history, Buffett, Bogle, Munger, don't try to predict timing. Instead, they trust the long-term trend: the market rises. Always has. Always will. So when you see a so-called guru on CNBC, remember this: you're not watching a financial prophet. You're watching an entertainer. The guru's survival trick. Now here's the clever part. Collins explains the survival trick that keeps gurus relevant. They make lots of predictions. Some turn out right. Those are the ones they highlight. The wrong ones are quietly forgotten. Over time, this creates the illusion that they're often right, when in reality, they're no better than chance. It's smoke and mirrors. A performance dressed up as expertise. The reality for you. So what does this mean for you, the investor watching at home? It means you must resist the temptation to chase predictions. Don't buy because a guru said stocks are about to boom. Don't sell because another guru warned of doom. Instead, remember the only truth that matters. The market always goes up, given enough time. That's the anchor. That's the certainty. Not what some talking head shouts on TV. The punchline. If you want to be a stock market guru and get on CNBC, it's easy. Speak boldly. Predict confidently. Forget quickly when you're wrong. But if you want to be wealthy, truly wealthy, Collins says, ignore the noise. Stop chasing forecasts. Put your money in the market and let it work for decades. Because the real gurus, the Warren Buffetts of the world, aren't on TV making guesses. They're quietly investing, holding, and letting time do the heavy lifting. And with that, the curtain falls on the myth of the market guru. The lesson is simple: don't be dazzled by predictions. Be guided by principles. Magic beans, you, too, can be conned. Close your eyes for a moment. Imagine you're walking into a sleek financial office. The walls are glass, the desks polished, the advisors dressed sharp in their tailored suits. Their smiles are reassuring. Their voices calm. They lean in and say, "Don't worry, we'll take care of everything. Just trust us." It feels safe. It feels professional. It feels like you found the right people to handle your money. And that, Collins warns, is exactly how you get conned. The business of selling you dreams. Here's the truth: Wall Street doesn't exist to make you rich. It exists to make itself rich, by taking a piece of your money every step of the way. Advisors promise to beat the market. Mutual fund managers claim to have a special formula. Brokers nudge you toward frequent trading. All of it is designed to extract fees, commissions, and percentages from your nest egg. And the scary part? Most people never even notice it happening. The illusion of expertise. Collins calls this the illusion of expertise. Think about it. If you walk into a doctor's office, you expect real knowledge. If you hire an engineer, you expect real skill. So when you hire a financial advisor, you assume the same. But the dirty little secret? Most financial advisors aren't experts at building wealth. They're experts at selling products. Mutual funds with high expense ratios. Insurance policies disguised as investment vehicles. Complex strategies that sound sophisticated but underperform a simple index fund. They look like professionals. They sound like professionals. But their loyalty often lies with the firm that pays them, not the client who trusts them. Why it's so easy to fall for it. We get conned because we want to believe. We want someone to tell us, "Don't worry, I'll handle it." We want someone to say, "I can beat the market for you." We want shortcuts, magic formulas, and secret strategies. That desire makes us vulnerable. And Wall Street knows it. The harsh reality. Collins doesn't mince words: most people waste years, sometimes decades, paying unnecessary fees, following bad advice, and chasing false promises. And all the while, the simplest and most powerful strategy, buying and holding low-cost index funds, sits quietly in the corner, overlooked. Why? Because it doesn't make Wall Street rich. It only makes you rich. The lesson. So how do you protect yourself from being conned? Learn enough to see through the sales pitch. Understand that nobody has a crystal ball. Recognize that complexity is often a disguise for higher fees. And most importantly, take control of your own money. Because no one, not your advisor, not a broker, not a guru on TV, cares about your wealth as much as you do. The punchline. Collins leaves us with a simple, sobering reminder. You, too, can be conned. Even smart, educated people fall for it every day. But if you remember the core truth, that wealth is built by owning the market through simple, low-cost index funds, you'll never again need to hand your future to someone whose real goal is lining their own pockets. What to do when you get there? So you've walked the simple path. You've worked, saved, invested, and stayed the course. Now, you've reached the promised land of financial independence. But here's the question many don't think about until they're standing in it: what do I actually do now? How do I live off this money without running out? This chapter is the roadmap for that stage of life, the transition from accumulation to enjoyment. Withdrawal rates: how much can I spend anyway? The golden number Collins leans on is 4%. Here's how it works. If you've saved 25 times your annual expenses, you can safely withdraw about 4% of that portfolio each year. Historically, across decades and market cycles, this withdrawal rate has proven sustainable. It's called the 4% rule, and it's simple: if you spend less than or equal to 4% of your portfolio per year, the odds of your money lasting your entire life are very, very high. Now, Collins points out, this isn't magic. Markets go up, markets go down. Some years you'll be withdrawing from a growing pot, other years from a shrinking one. But the long-term data is clear: if you stay disciplined, 4% works. The trap. People often try to overcomplicate this. They second-guess. They think they need exact precision. But just as with investing, simplicity here is your ally. How do I pull my 4%? Okay, so you know the number, but how do you actually withdraw the money? Collins lays out practical steps. 1. Dividends and interest first. Whatever your investments pay out naturally, use that as part of your 4%. 2. Sell shares as needed. Don't be afraid of selling. Remember, your portfolio is designed to support you. Selling is not losing money, it's using the money you built. 3. Maintain simplicity. With a core holding like VTSAX, the total stock market index fund, and perhaps a bond fund for stability, withdrawals are straightforward. The key lesson: pulling your 4% doesn't require elaborate strategies. It doesn't require special withdrawal products. It just requires the same calm, steady discipline that got you here in the first place. Social Security: how secure and when to take it. Now we come to a topic that makes many nervous: Social Security. Collins doesn't sugarcoat it. The system has challenges. Funding gaps. Political debates. But here's the important truth: Social Security isn't going away. The rules may shift, benefits may adjust, but it's highly unlikely to vanish altogether. So the real question is, when should you take it? If you take it early, at 62, you'll get smaller checks but start sooner. If you delay until 70, you'll receive significantly larger checks for life. Collins emphasizes, this isn't just about math, it's about lifestyle. If you've already achieved financial independence, delaying might make sense, since your portfolio can support you until the bigger checks kick in. If you need the income earlier, then starting sooner might be best. There's no universal answer, but understanding the trade-offs allows you to make the choice from a position of strength, not fear. How to give like a billionaire. And now, perhaps the most joyful part of all: giving. Collins points out that true wealth isn't just about security, it's about freedom and generosity. Once you're financially independent, you have the opportunity to shape the world around you in meaningful ways. But here's the beauty: you don't need billions to give like a billionaire. Through tools like donor-advised funds, DAFs, you can set aside money for charitable giving, let it grow tax-free, and direct it to causes you care about, on your timeline. This means even a modest sum can have a multiplying effect over the years. Collins reminds us, giving isn't just about writing checks. It's about aligning your money with your values, creating impact, and finding fulfillment beyond your own needs. In fact, for many, the joy of giving becomes one of the greatest rewards of financial independence. Closing thought. This section of the book feels like stepping into the sunrise after a long journey. You've worked, invested, stayed disciplined. Now you're here, living off your wealth, navigating Social Security wisely, and even giving back in powerful ways. Collins' message is simple and profound: financial independence isn't the end of the path, it's the beginning of a life fully lived.